Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into UHAL Holding Company, ticker symbol UAL, the unquestioned heavyweight champion of the do-it-yourself moving world.
And here's the core thesis, right up front for you. U-Haul is weathering an earnings crush from fleet cycle accounting while aggressively expanding his dealer network and U-Box moat, positioning the stock as a hidden asset play currently masked by temporary volatility.
That thesis sets up a fantastic deep dive because, when most people see that massive orange truck in their rearview mirror, they think simple moving service. They don't think about complex capital expenditure cycles or gap accounting rules or depreciation schedules. But to understand UL, you really have to get their history and their extreme long-term mentality.
It's absolutely essential context. U-Haul was founded all the way back in 1945 by L.S. Sam Schoen.
Okay, post-war.
Exactly. And the brilliance of the concept was so simple, solving his desperate need for one-way rentals. Before Schoen, if you rented a trailer to move from New York to California, you're a live. You had to haul that empty trailer all the way back yourself.
That sounds logistically impossible.
It practically was. So Schoen solved this by building a national network, starting with genuine bootstrapping, famously building those first trailers using parts salvaged from junkers.
Really? From old cars?
Yep. That foundational ingenuity, prioritizing scale and the network over short-term profit, that's still in the company's DNA today.
And that heritage is directly tied to why the company operates the way it does now, especially its governance style. We can't really skip the period of, massive internal strife the Schoen family went through.
That family history is crucial background. It completely informs the investment thesis. The intense internal Schoen family conflict, which just dominated the company for decades. We're talking roughly 1986 all the way to 2012.
Wow, that's a long time.
A very long time. It forced management to develop this culture of profound resilience and an extreme long-term focus. Because they're still a controlled company, they have the unique freedom to pursue these multi-year strategic investments that might depress the stock price in the short term, but which they believe solidify their dominance over decades.
And what that approach has built is an empire of just incredible scale. We're talking about a network that spans over 25,000 locations across North America.
It's that sheer physical infrastructure that matters, and they haven't stopped there.
Yeah.
Well, you know them for the trucks. They have diversified into two other critical segments.
Yeah.
Self-storage, where they are now the third largest provider in North America.
Third largest.
And the fast-growing U-Box portable storage segment, which, it essentially uses their massive existing footprint as an inherent advantage.
Okay, let's unpack this and get into the financial pressure they're under. Specifically, those recent Q2 results for fiscal year 26. This is where the story gets really contradictory because the headlines look painful, but the core business metrics look surprisingly healthy.
Is the definition of financial whiplash. On the surface, the company's growing. Consolidated revenue for Q2 came in at $1.72 billion.
Okay, that's up.
It's an increase from $1.66 billion. But then you look at the bottom line, the net profit, and it's a disaster. Net earnings plummeted to $105.6 million, a steep fall from $186.8 million year over year. That's a massive drop.
That's where the earnings crush thesis earns its name. What specific accounting mechanism is creating this massive gap between growing revenue and falling profits?
It's entirely due to the necessary but highly painful fleet replacement cycle hitting the income statement. We can trace the decline directly to a $107 million year-over-year cost swing.
$107 million. And this wasn't an operational failure.
Not at all. It was a 1-2 punch from their fleet spending. First, you had a $50.6 million increase in depreciation expense. That's from bringing in significantly more expensive newer box trucks that have to be depreciated.
And the second pun?
That came from the disposal losses. They booked a $56.1 million increase in disposal losses on the older equipment they're selling off.
Why so high?
Two reasons. One, the older units they're selling now have a higher book value because of how they were bought years ago. And two, the used truck market has softened dramatically, so they're selling those assets into a slump.
So they're getting hit on both ends. A hit on the new fleet with higher depreciation and a hit on the old fleet with lower resale prices. On paper, it looks like U-Haul is struggling to manage its costs, which seems like a major risk.
It does, but that raises the crucial counterpoint that proves the core business is robust. If demand was truly weakening, you would see it in their operational metrics. But the data shows that the moving and storage adjusted EBITDA actually increased by $31.6 million, reaching $542.6 million in Q2.
Wait, so when you say adjusted EBITDA, you're essentially filtering out the exact capital spending and fleet accounting noise we just talked about, right?
Right.
You're seeing the underlying business health much more clearly.
Exactly. That 542.6 million EBITDA confirms that demand is strong, their pricing power is holding up, and the operating business itself is healthy. The net earnings crash is purely a function of the accounting cycle, not a failure of the moving service itself.
Here's where it gets really interesting. Because management is not just sitting back and waiting for this accounting storm to pass. They are executing a pretty aggressive strategy to solidify their dominance while this headwind is blowing.
Right. Their core focus is doubling down on geographic density. Management is aggressively expanding the independent dealer network at a pace they themselves call well above the historical pace.
So this isn't just about small growth.
No, it's about making sure that U-Haul achieves this overwhelming proximity advantage. They want to ensure that for pretty much every renter, a U-Haul location is closer and more convenient than anyone else.
And that focus on density directly feeds into their key growth engine, the U-Box container service. We've all seen PODS and the other rivals, but U-Haul has a structural advantage there, don't they?
A massive one. The U-Box service is a genuine growth catalyst. It's part of other revenue, which increased $12.0 million in Q2, mostly thanks to U-Box. What's critical is that U-Box is unequivocally gaining market share because it leverages the company's existing infrastructure.
So they don't have to build out a whole new network.
Exactly. Rivals have to build new storage yards. U-Haul already has 25,000 locations where they can drop off and pick up those containers. They already own the real estate, the moving funnel, and the logistics. It's an incredibly cost-efficient moat.
And on the self-storage side, they made a deliberate move in Q2 that looked like a weakness, but was actually a conscious choice to improve the quality of their portfolio.
That's right. They intentionally accepted a 3.5% drop in same-store occupancy, landing at 90.5%. If you look by unit count, it dropped from 80.9% to 76.3%. This wasn't because of low demand.
It was a management decision.
A very deliberate one to cull delinquent tenants. They kicked out the people who weren't paying to prioritize reliable, high-quality revenue streams over just a high occupancy number, a classic long-term move.
Let's pivot and analyze the capital structure that enables all this, and then look ahead to the recovery. I mean, this massive fleet investment has pushed up their leverage.
It has. Total debt increased to $7.73 billion, and that level of debt would normally concern an investor. But you have to view it in the context of their underlying asset base.
And that asset base is where the hidden value proposition comes in. This is the definition of a hidden asset play, isn't it?
Absolutely. This is maybe the most important insight for you. U-Haul's vast real estate portfolio, there are thousands of locations, is carried on the balance sheet at historical cost. That's just standard accounting.
Meaning its true market value is far, far higher than what's on the books.
Precisely. Management has openly disclosed that they have the capacity to borrow an additional $2 billion against their existing real estate if they needed to. That facility is direct evidence of substantial unbooked equity and acts as a massive margin of safety, offsetting the risk from the operational debt.
And for investors who are tired of watching the P&L bleed from those depreciation costs, when does the pain stop? What's the timeline here?
The depreciation outlook gives us a pretty clear signal. Management indicates the cost pounding from the fleet cycle will subside as the capital deployment normalizes. They project that the high depreciation expense on new trucks is expected to peak toward the end of this fiscal year or early next year.
So once that peak hits...
Once that depreciation expense starts its inevitable downward trend, those bottom-line net earnings figures should snap back quickly, fully reflecting that healthy core operational EBITDA we see today.
So what does this all mean for someone trying to make a decision on UA? When we pull it all together, the volatility, the operational strength, the hidden assets, is this a long-term buy, or is the macro environment just too risky right now?
The bull case is powerful. You have this combination of achievable operational dominance, that aggressive density expansion, and the scaling U-Box growth, plus the substantial hidden real estate equity. That provides significant downside protection, and it really supports the long-term buy thesis. You're basically investing in a temporary accounting dislocation.
But isn't carrying over $7.5 billion in debt just inherently risky, regardless of the collateral, especially if the housing market slumps for a long time?
And that is the core of the bear case. The macro sensitivity to housing market stagnation is the big external risk. I mean, we've seen existing home sales flatline, housing starts are down, permits are down. If people aren't moving, U-Haul's business will feel that pressure.
And there's the governance issue.
Yes, you have to accept the governance discount. The Schuh and family's control allows them to make these expensive, long-cycle investments and ignore short-term market pressure. That can keep the stock volatile and depressed for periods that frustrate public investors.
Ultimately, the decision comes down to trusting management's ability to navigate that micro headwind while executing against what is essentially a self-inflicted accounting wound. The real takeaway here for you is that U-Haul's profitability decline is mainly driven by how they account for the assets they buy, not a deterioration in the demand for what they sell. When that depreciation cycle eventually turns, the rebound in net earnings could be dramatic, revealing the strategic progress they built during this costly phase.
The fleet replacement headache is temporary. The geographic moat is permanent.
Risk defined, portfolio protected.